Now to American perspectives and Jeff Bezos. The founder and CEO of Amazon.com was Time Magazine's Person of the Year in 1999. Last month, he sat down with Stephen Shepard of Businessweek magazine for a discussion about the future of the online retail business. This 1-hour, 20-minute event took place at the 92nd Street Y in New York City.
Thank you very much, Elaine. Good evening and welcome, everyone. We're most fortunate in having Jeff Bezos, founder and CEO of Amazon.com, as our guest tonight. Our format, as some of you know, is very, very simple. After I introduce Jeff, he will come out, we will sit down in those chairs and have a conversation for 45 or 50 minutes. And then we will turn it over to you. We mean this to be an audience participation show and welcome your questions. So please fill out the cards and hand them over to people who will collect them. And we won't think you rude if you are writing out questions while we're talking. In creating and building Amazon, Jeff Bezos has invented something fundamentally new. An online retail store that stresses service, customization, and a great brand. Its sales last year hit $2.7 billion, up 68% over the year before. In 1999, he was named Time Magazine's Man of the Year. But the last couple of years have not been overly kind to Amazon. The company lost $719 million in 1999 and $1.4 billion in 2000. The stock, although it's had a nice run the last 3 or 4 days, is nonetheless down from its high of $113 in late 1999 to $13.32 as of closing today, which is a decline of 88%. Amazon has had to lay off 1,300 people and closed a warehouse or two. The question everyone is asking is whether Amazon will turn a profit before it runs out of cash. And we'll try to find that out tonight. Jeff likes to say he has built an e-commerce platform made up of its customers, its brand, its technology, its e-commerce expertise, and its distribution capabilities. On this platform, he says, it is far easier and cheaper to build new businesses. Amazon started out in July 1995 by selling only books, but has now become the internet's #1 retailer of lots of other stuff. More than 35% of its customers in the United States buy electronic gear, kitchen supplies, hardware, toys, and games. Amazon wants to get to know its customers, Jeff says, in the same way a small-town shopkeeper of yesteryear might have gotten to know them. That kind of personalization is going to be extremely valuable for the customer. To illustrate, if you go on the Amazon.com site under Family and Favorites, you can find out the best-selling books in our towns, among people in our occupations, and among employees in our companies. By the way, the best-selling book among Amazon employees is Harry Potter and the Goblet of Fire. So I guess Amazon employees aren't so different from the rest of us. The #7 bestseller, by the way, is called The Worst Case Scenario Survival Handbook. We'll let him explain that. But first, let's do a little personalization about Jeff. He grew up in Houston. His father, Miguel, left Cuba in the early 1960s and became an executive at Exxon. His mother, Jacqueline, worked in a bank. Jeff spent summers on a family farm in Texas, developing a love for science from his grandfather, a retired manager of the Atomic Energy Commission. By the time he was 14, he wanted to be an astronaut or a physicist. The family garage was always filled with his projects, from a vacuum cleaner on its way to becoming a hovercraft to an umbrella soon to be a solar cooker. Jeff flexed his entrepreneurial muscles in high school. He thought up the Dream Institute, a summer school program to encourage creative thinking in young school kids. Then he made his brother Mark and sister Christine pay to attend. Jeff was a perennial overachiever, valedictorian, and president of his high school class. At Princeton, he earned degrees in electrical engineering and computer science, summa cum laude. After Princeton, he appeared to be headed for a nerdy tech career. Instead, he worked for Bankers Trust Company here in New York for 4 years, and then he landed at hedge fund operated D.E. Shaw and Company, where he quickly latched onto the net. Soon he was heading across the country by car to start Amazon. Legend has it that he typed the business plan on a laptop and called investors on a cell phone as his wife drove. Her name, by the way, is Mackenzie. She's here with us tonight, and she's a novelist. For the first 4 years at Amazon, Jeff worked so much that he and Mackenzie couldn't find time to move out of their tiny studio apartment. Now they have a toddler, Preston, another on the way, and presumably a bigger place to live, although I didn't ask him. Through it all, Jeff has not lost any of his charm or sense of humor. His hyperkinetic energy provides a lot of Amazon's electricity, and I'm confident in saying that Jeff has the loudest laugh in Seattle, perhaps the loudest laugh anywhere. Ladies and gentlemen, please join me in welcoming the founder and CEO of Amazon.com, Jeff Bezos. Nice to see you.
Nice to see you too.
Thank you for being with us.
I'll try not to burst anybody's eardrums,
Right.
but hopefully they passed out prophylactic earplugs on the way in. I think that would be very important.
Unless they already heard you from backstage. Let's back up and start at the beginning with the idea for Amazon.com. How did you get this idea? When? How? Why?
Well, I was at the hedge fund I worked at was a quantitative hedge fund. We used Unix everywhere. Mosaic was the first graphical browser on the World Wide Web. And in 1994, in the Unix community, a lot of people were talking about Mosaic and the World Wide Web, and it was growing explosively. David Shaw, my boss, assigned me to look at different things that D.E. Shaw & Co., the company, might do in and around the internet. And the more I poked around in it, I found this one fact, which I found just astonishing. On a website, I found that web usage was growing at 2,300% a year. This is a time when nobody could know what the baseline usage was, but it was quite easy to figure out the growth rate. And anything that doesn't have a completely trivial baseline that's growing that fast is invisible today and ubiquitous tomorrow. And that really was sort of the wake-up call for me. And I went and got a book on mail order and looked at all the different categories that do well by mail order and started force ranking those and shifting them around. Books is near the bottom of that list. But it became clear that the reason that books wasn't a great mail order product is because you can't put a decent selection in a catalog, in a paper catalog. It's impossible. So from that point, about 15 months later, we launched Amazon.com in July of '95, and at that time we launched with 1 million titles, which is 5 or 6 times as many titles as you'd find in even the largest superstore. And if you were to print that in a paper catalog, it would have been the size of 13 New York City phone books. So that was the sort of the insight that led to Amazon.com.
Yeah. Now, is that story true, that you actually typed out the business plan while
The first draft of the business plan was indeed written on the way. The idea was already well formulated. Yeah. A lot of research had been done, but the first draft, it's not true, however, legends grow. It's not true, however, that I called investors on the way. I did call a lawyer on the way from the cell phone, and I said, this is a lawyer in Seattle, a local lawyer, and who I just gotten from a friend. Strangely, this was a general practitioner. You kind of think of this in grand terms, but this had been my friend's divorce attorney. And I called this guy up and just said, I need you, could you incorporate the company? And open some bank accounts for us, because when I get to Seattle, I want to already be hitting the ground running, and I don't want to have to do some of this stuff like incorporation and have that done. And he said, sure, that's no problem, easy to do. What do you want the name of the company to be? And over the cell phone, I said, Cadabra, as in abracadabra. And he said, cadaver? And it was pretty clear at that point that that wasn't not a good name. Yeah. Yeah. How do you spell cadaver? Yeah. No. So the name, we changed the name about 3 months later. It was officially incorporated as Cadabra Inc. and then changed about 3 months later to Amazon.com.
Yeah. Now, when you had the idea, was it just books, or did you imagine that at some point it would be?
It really was just books, and the reason for that is startup companies need to be absolutely laser focused. You know, so many startup companies I see, and I talk to entrepreneurs, and I see them. They have too many things going at once, and it's really, really important when you have these. You know, you have these initial precious resources, and they're so very finite that you need to be very focused. And we expected to slowly grow the business out of cash flow, as most businesses are grown. You have to remember that in the, when we were putting together the plans for this, and even when we launched it in July of '95, the internet was a very small place compared to what you saw in '98, '99, and 2000. And certainly people weren't raising millions of dollars. Amazon.com was started with a few $100,000, most of which came from my parents, always a good source of angel investment capital.
The ultimate patient investor.
Yeah, that's right. I told them I thought there was a 70% chance they would lose their investment, and that's because if you look at the statistics, there's a 90% chance that they'd lose their investment. I decided I would give myself triple the normal odds because I'm so confident and optimistic. So that, but I really wanted them to know there was a good chance they'd lose their money because I wanted to be able to come home for Thanksgiving. So it worked out very well for them, of course, which I'm extraordinarily happy about.
I'm sure they
And
are
it was
too.
great faith, believe me. There is no, my dad's first question was, what's the internet? So this wasn't, they were investing in their son, not this idea. And that's another reason why parents make such good angel investors.
Well, good for them. You've now branched out to a lot of products. What other products would you consider from this point on? And are there products that are just, not suitable at all?
Well, so different products will be suitable to different degrees, probably. Books is clearly one of the best, and the reason that we did it first. As the internet gets more sophisticated, more and more product categories become possible. If you can think back 5 years, which is difficult because everybody forgets, that was when everybody called the World Wide Web the World Wide Wait. The fastest modems that the average person had were about 14.4. A few people had 28.8 modems. The browsers crashed every 15 minutes. It was an incredibly primitive and infant technology. It's still very primitive compared to where it will be 5 years from now. But that, when you have such a primitive technology, you can only do a very prescribed number of things. As the technology gets better and better, you're able to do a larger and larger number of things. So, I'm, for one, one of the categories that I'm very, very optimistic about is our electronics business. And there are just a lot of economic advantages to selling electronics online. Again, we can have the selection advantage. We have 25,000 different electronics items in our store compared to about 5,000 in a big electronics superstore. So I think there'll be a lot of categories, and even some of the categories that initially fail, like furniture and pets, both of which we were major investors in, will fail, and then they'll come back again.
Yeah, ultimately. Is there much crossover? Do people who buy books buy lawnmowers?
Sure. Yeah, not in New York City.
The books or the lawnmowers?
They buy the books here. Yeah.
Well, we made the right choice.
The books are more fun.
Yeah. But there is crossover. I mean,
sure there
music
is.
Buyers will buy kitchen stuff and so on.
Yeah. That's right. Try the OXO salad spinner. I challenge everybody in this room to read the customer reviews for the OXO salad spinner and then not buy an OXO salad spinner. They read like sexual experiences. I mean, it's an extraordinary set of reviews. Anyway, and it is a good
So you're
salad
running
spinner.
a porn site, is that it?
Oh, yeah, and a salad spinning site.
So what are the products that you think will drive the future growth?
Well,
I mean, short run, next 2-3 years.
well, for us right now, the segments of our business that are growing the fastest are our international segment, which is books, music, video, software. Actually, in Japan, it's just books today. But also then in the U.S., it's what we call our early stage businesses, which is mostly our hard lines businesses. So it's electronics, it's tools, it's kitchen. Those are the businesses that are growing the fastest.
Are those higher margin businesses than books and music?
So it depends. If you're looking at dollar profit per item, the answer is yes. So this is one of the things that I think gets frequently misunderstood, especially in the electronics category, where, let's say you're talking about a $300 digital camera. That may have a 15% gross margin or a 10% gross margin, but that's still $30 or $45 of gross profit. If you take a $20 book, that may have a 30% gross margin, which sounds better, but it's really only $6 of gross profit. So, and if you look at the way we do things, we have distribution centers. It costs us about the same to receive, stow, pick, sort, pack, and ship a digital camera as it does a book. So the camera can actually be much more profitable, even though the gross margins are lower.
Right. Now, you have had this very good partnership with Toys R Us, benefit to you and to Toys R Us.
Absolutely. They've been fantastic partners.
Will you look for other such partnerships? I mean, beyond what you announced today with Borders?
Yeah, I think there's an opportunity there. One of the things that we've done over the last 6 years is build a platform, and it consists of those things you listed at the beginning. And the way we built that platform is by thinking exclusively about our own customers. So, we wanted to make the website very easy to use. We wanted the distribution centers and so on to work reliably. We wanted customer service to work reliably. All this stuff together made us very good at e-commerce. And I think widely recognized by just about everybody, even really by our critics, as the best possible online shopping experience. Right. And what we're finding is that there are a lot of physical world companies, Toys R Us and Borders being the first two examples, that have found it's very, very difficult to do a good job online. And so they've teamed up with us so that they can focus on their in-store experience, which is a very difficult business in its own right. And then by partnering with us, have a top, A+ quality rating offering for their online customers. Right.
So in the arrangement with Toys R Us, you essentially do the front end.
That's right.
The selling, and the back end and the shipping and so on is done by Toys R Us in that case.
Actually, we do all of the shipping and fulfillment. We do all the physical handling of the merchandise, but we don't own the inventory. So we handle the inventory, but Toys R Us owns the inventory. And that's very important because in the toy business, one of the hardest things about the business is buying in March for what 10-year-olds are going to want in December. So that's such a difficult thing and such a critically important competency in that business that it's so much easier for Toys R Us to do it than us. But we actually are physically
But why wouldn't you take
all that merchandise is in our distribution centers.
Why wouldn't you take it to the next step and say, you're really unique at the front end, the virtual store, and they know how to ship toys. Well, let them do the bricks and mortar part, and you do the virtual part.
What we're finding is that the bricks and mortar companies don't know how to do the back end part of our business because it's completely different. We are one of the only, actually, as far as we know, we're the only company that has a distribution center network that ships millions of SKUs, millions of different items to millions of different customers. So if you look at the distribution center network of a major, leading retailer like Toys R Us, they will have very sophisticated distribution center infrastructure, but it's purpose-built and designed to ship cartons of product to stores, not single items to customers. And it's a completely different thing. In fact, you emphasize different things. Think about it if you're shipping things to stores, and if somebody orders, 100 of something, if a store orders 100 of something and you ship them 95, that's actually okay. Or if they you ship them 105, that's also okay, as long as you're keeping track of it. But that's not okay if it's an individual customer. So you need much higher levels of accuracy than you do when customers are picking the items off the shelves themselves.
Would you consider just being the user interface for some bricks and mortar company which would handle the total back end?
Sure. I mean, the way we look at this platform is it's assembled from a number of pieces. So there's the website, which has personalization and one-click shopping and search and browse technology that corrects misspellings and all the things that are designed to make it easy. That's a very important piece of what we have to offer. There's the customer service and fulfillment. That's a very important piece. And there's access to Amazon.com's customer base. That's another piece. And so if you sort of look at these different pieces, I suspect that different partners will want to sort of assemble an offering out of different pieces, and we're agnostic about that. As long as it's good for the partner, good for us, and great for the customer, as long as all three of those parties benefit, we'll be interested.
Right, and then you can leverage your investment.
That's exactly right.
All right, let's get down to the money questions, which you've been asked about a lot.
I've never heard these questions before.
Cumulatively, you've lost a fair amount of money. You're losing less than you lost last quarter, but you're still losing. Give us some idea of when you think Amazon will start making money.
Well, so our short-term goal in that regard is, as a first step, we would like to have a pro forma operating profit this Q4. And, for 5 years, we've declined to even answer that question until just recently. And the reason was we didn't feel like we had enough visibility to responsibly answer that question. And now we feel like we do. We've just had, 5 quarters of progress in some important operational metrics and in our pro forma op-loss numbers. And so that's the thing that's giving us the visibility. There are no guarantees, and there can't be, to make that forecast.
Now, explain to everyone what you mean by pro forma, because that's not the same as net income, which is the traditional.
Sure. Well, there are two things. So there's pro forma, and there's pro forma versus GAAP, and there's operating versus net. So operating income is different from net income because operating income excludes taxes and interest primarily. Because we're in a loss position and have significant loss carry-forwards, for us, the difference between net and operating is primarily net interest expense. The difference between pro forma and GAAP is largely a bunch of non-cash charges that primarily relate to goodwill of acquisitions, investments that we made that didn't work out and we wrote down, things like that.
Mm-hmm. So the prediction is about pro forma earnings.
Correct.
Fourth quarter of this year, you'll be in the black on a pro forma basis, which will include goodwill and those items you just mentioned. Are you able to make...
I think it excludes.
I mean excludes.
Right.
That's what I meant to say. Wasn't a trick question. Plain old mistake. Are you in a position to talk about net income?
No, we're not, and we will make those forecasts as we get closer. But at this point in time, we're taking it one step at a time. We're making a very precise prediction, and there's a lot of work to make that. It's not a slam dunk.
Yeah, well, let's talk about
we
that.
feel very good about it, and
what
we're
has to
focused on it.
change for you to start making money? More customers, higher prices, lower costs, fewer products, more products, better service? What? Most
of the change that we're driving is in various kinds of operating efficiencies. So if you look at what we did over the last 5 years, we followed a strategy of get big fast. And that was a really important thing to do. And the team that we have at the company really focused on it very strongly. And it worked. If you look at us versus most of the other competitors in our space, and by the way, the way we did that was by doing a great job for customers. It wasn't that we were genius marketers or anything else. Our best marketing dollars have always been spent on making the website better and easier to use and making distribution centers and customer service better. Those are our best marketing dollars. So we've done a great job of that. And then what we have to do is turn a good portion of that focus, which was devoted to growth, to operating efficiency. You know, it was only 3.5 years ago, it's very hard to remember, that when we, at the time of our IPO, we had annualized sales of about $60 million a year. Now, when you have sales of $60 million a year, if you can get a 1% operating efficiency by doing a bunch of hard work, that will net you, over the course of the year, 1% of 60 million, which is about $600,000. That's not very much money. And really what you should be doing is, instead of investing all of that executive bandwidth, time, energy, hardworking people on trying to get that 1% operating efficiency, you should instead be trying to build a company of the scale where 1% matters. And we are now clearly at that point. In fact, you know, about 18 months ago, we really started on that inflection point, changing the way we manage the business to put more emphasis on operating efficiency. Because now, with, you know, $2.7 billion in sales, 1% is no longer $600,000, it's $27 million. These are big numbers. So we've got tons of headroom in operating efficiency. For example, we have fulfillment expense for us, which is the distribution centers, the customer service centers, credit card expense. That's, a year ago, was 16% of sales in Q4 of '99. In Q4 of 2000, that was about 13.5% of sales. So, you know, we got about 250 basis points, 2.5%, in that area. And we believe over the long term that that can be in the high single digits. Mm-hmm. But there's just a tremendous amount of work to do there. And by the way, it's incredibly fun, intellectually challenging work. It's every bit as much fun as being focused on making sure that we achieve the scale necessary to be a lasting company.
Yeah. Well, there's a trade-off here. I mean, you know, you could say we would grow to $5 billion without worrying about profitability. You could say we should have gone for profitability as a somewhat smaller company. In retrospect, do you think it would have been better to grow a little more slowly and get to profitability sooner?
I actually suspect that we probably timed things about right. The reason that scale is so important in this business is because the fixed costs are so high and the variable costs are relatively low compared to a physical store. So, you know, physical stores, a single physical store can be profitable. And, excuse me, that's what they, in fact, they have a term for it. They call it four-wall profitability. And if you build 500 such stores, you know, roughly speaking, 500 such stores will be about 500 times as profitable as one store. Not quite, because there are some efficiencies, but basically, you know, if you're going to double your sales, you have to double your number of selling square feet, you have to double your number of sales associates. So as you double sales, you also double costs. That's not how our business works. We have very high fixed costs in software development, content development. In fact, in some ways, our business is a lot more like yours, where, you know, the cost of putting Business Week together is going to be largely independent of your circulation.
Mm-hmm. That's true. We don't have $2.7 billion in revenue.
But you probably don't have our losses either.
However, we're profitable.
But wait, I'll tell you, we had a...
So you want to trade places? Is that what we're saying here?
We're okay where we are. But
so are we.
That's right. I think we're both well suited for our roles. So the next round of funding after my parents was a group of about 20 angel investors, and they invested $1 million. It took about 4 months to raise that $1 million, and you know, so roughly $50,000 each from about 20 different people. And recently, one of those 20 original investors gave me a present, And he wrapped it in the original Amazon.com business plan that I had given him, which I hadn't seen in years. And I looked at our year 2000 projections, and we were due to have about $70 million in sales instead of $2.7 billion. But we were also due to have a profit of about $4 million. So certainly, we adapted our business plan.
Do you still have that original business plan?
I
You
do.
should auction it off on eBay or something?
No, I think I'll keep that.
It'll be worth more later.
It's a nice memento.
Yes. Now, we're in a slump. Some people say we're in a recession. Does this affect your business, your sales? Are you seeing any signs of this slowdown?
Well, I certainly wouldn't want to give any mid-quarter guidance of any kind. 2 days ago, we did reiterate guidance for the year 2001. We had already been appropriately conservative, back when we announced our Q4 results. So this is I think what we're seeing here, people are probably a little jumping the gun to call this a recession. It's clearly a slowing of growth. And I think what will come in the future is very difficult for people to know. It's very easy, of course, to find people to prognosticate upon it as if they know. But I don't think very many people really know.
Yeah. What's bothered people, of course, is the abruptness and the degree
That's
of
exactly right.
I mean, it went from 5% growth to 1 at best now very quickly.
In the course of a year, the figures I saw went from 8% growth to 2% growth in a single year.
Yeah. There was 1/4 of 8% growth.
That's right.
Yeah.
And that rate of slowdown is astonishing.
Yeah.
Whereas if you look at some of the absolute numbers, they're not very upsetting.
Yeah.
But it's the change.
Talk a little bit about the stock price. I look at these things, and you go from 113 to a low of about 8 a little while ago. You're up to about 13 now. How do investors even begin to think of valuing a company like Amazon?
Well, it's very difficult. If you look at, the only way I know how to think about Amazon.com is in the very long term, because the sector that we're in is a highly volatile sector. And it certainly was subject, as everybody can see now, in 1999, to this period of irrational exuberance, to use Alan Greenspan's phrase. And that, and if you look, it's very interesting. If you look at a stock chart, we had our IPO in May of '97, and split adjusted, our IPO price was $1.50. That was were the days when we were branded Amazon.toast, because the big bricks and mortar retailers were coming online, and they actually had good arguments, the people who branded us Amazon.toast, that powerful brand names, lots of purchasing power, 50 times the sales, 30,000 employees instead of a couple hundred employees. The stock actually traded down below its IPO price for a while. So, you could have bought just 3.5 years ago, at the time of our IPO, Amazon stock for, say roughly $1.25. And it's up, of course, a factor of 7 or 8, even today, which over 3.5 years is not a bad return. Most of the people who bought and held from our IPO, maybe they cursed themselves from not selling at 100, but they certainly, this is still, in many cases, their single best investment ever, even today. The problem is it went via 100. If it had just been a single smooth line up and to the right, everybody would be thrilled. But unfortunately, that's not how stock markets work, especially in a period of exuberance like that. Benjamin Graham is famous for saying that in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And that's clearly very true. I've long warned individual investors, I started doing this 2 years or so ago, away from Amazon.com and other internet stocks, not because of the absolute price levels, because I think it's very hard at any given point in time to be smarter than the market, but just because of the volatility. If you look at the volatility of these stocks, they're not individual investor stocks, in my opinion.
Yeah.
They're just not
a very strong stomach.
They're not sleep at night stocks. That's right.
Yeah. If you are at a pro forma profit by the fourth quarter, money is still going out because obviously you have to finance the debt. Will you need, even if you're pro forma profitable and that continues, will you need additional financing?
Well, we don't think so. We've been very clear about that, and we've said that we don't need any additional financing. If we were to do a financing, it would be for strategic flexibility or to strengthen the balance sheet. But for operating reasons, we don't need it. In the year 2000, we raised about $700 million, and we already had $700 million at that point. So we basically, began the year 2000 with about $1.4 billion in cash. We ended the year 2000 with about $1.1 billion in cash. So we used about $300 million in that year. In the year 2001, we have told people that we expect to use about $200 million in cash and end the year with about $900 million in cash. So we're very comfortable with our cash position, despite some of the things that you read. In fact, we had great good news today because Moody's, the credit rating agency, it was a surprise to me, came out and said that they were moving us from a stable to a positive, and said that by their analysis we have at least 18 to 24 months of cash. So, yeah, thank you.
All of this obviously is
Which is what we've been saying for a while, but people listen to Moody's more than they listen to us.
What have you learned from the general .com crash, not just the Amazon experience?
So I think the most important thing is to very clearly separate, and it's so hard for people to do, but to very clearly separate the customer utility from the stock market. In other words, the companies that are getting built really are creating significant intrinsic value. And I was recently pressed on this point by one journalist. In fact, I think it might have been a journalist who works for you, Rob Hoff, and I was making this point that the company is not the stock. And the clearest way I can describe it is that in the year 1999, when the stock market was booming, and Amazon's stock price in particular was booming, we had about 14 million customers buy from us in that year. In the year 2000, where the stock was busting, we had about 20 million customers buy from us. So if the stock is the company, somebody forgot to tell the customers. And this is I think this is a very common kind of conflation of two very separate things. And so there will be many winners created online. The right analogy is the Cambrian explosion 550 million years ago. This was when single-celled life exploded into multi-celled life, and you saw the greatest rate of speciation ever seen. But it was also the greatest rate of extinction ever seen. And that's exactly what's going to go on here. It makes sense from society's point of view for all these experiments to be done. If you're one of the extinct species, it doesn't feel too good.
But it goes away in 500 million years anyway, so
exactly. That's the long term.
We finally got him to laugh, see? But really, there are two sets of customers, right? There are the customers who buy things from your platform, and that's a great experience. The other set of customers, of course, are the investors in your company. And so while it's true that there's the stock price and there's the company, you have to satisfy two sets of customers.
Well, I'll tell you, the best way, first of all, you have to make a decision on whether you're going to try to satisfy all investors, which I would claim is impossible, or whether you're going to try to satisfy long-term investors. As I already said, for the people who've been with us for, since we first floated our stock on the public market, this is for many of them still the single best investment they've ever made. So for our long-term investors, we're very proud of our performance. And it's very difficult to please short-term investors. I think it's a mistake because to please short-term investors, you have to make trade-offs which are not in the interest of your customers. Whereas what long-term investors want to do, they want you to figure out how to please your customers. The way you please long-term investors is with long-term results. And the way you get long-term results is by offering something of genuine value that improves people's lives, saves them time, saves them money. That's the way you do that.
When you
There's
look
no trade-off there between customers and shareholders. And by the way, you can have, this is a Warren Buffettism, but he says you can hold a rock concert or you can hold a ballet, but don't hold a rock concert and advertise it as a ballet. You're going to make people unhappy. So, the goal here is to be as clear as we possibly can about the fact that this is a company which is inappropriate for short-term investors and hopefully very appropriate for long-term investors. So I guess, we're saying we're a ballet.
Yeah. That message, of course, got lost, no fault of yours, but it got lost in the frenzy of the last couple of years. So,
I think that's largely right.
Now, who do you like out there? I mean, there are a lot of companies that have sprung up as a result of the internet, some of which offer very unique value in things that couldn't be done without the internet, for example, eBay. Who do you think has got...
Well, I think one of the very interesting companies is Google. I think they're doing
the search engine.
Yeah, the search engine. I think they're doing a fine job. So that's... I think that's...
What's their business model? How do they make
Well, that's a good question. Yeah. You'd have to ask them. I don't know. I think they have an advertising-based model, which I know is really in vogue right now. And but they're very smart guys. I've met them, and I predict, the beginning of the right beginning is to have something that customers value, and they've certainly built that. That alone is not enough. Right. You also do need a business model. Ours was always simple because it was the traditional retail business model. You buy products at one price and sell them at another price. So,
who else do you like? eBay?
I think eBay is a great company. I think Yahoo is a great company. I know they're under a lot of, stress and distress at this point in time and going through a lot of changes. Just had an announcement today, which I'm sure is very troubling for them from a personal point of view, and I know the folks there and have a great deal of respect for them. But they also have built something that's very valuable to customers. And they have to figure out how to make this transition from having lots of .com companies who are willing to pay very high CPMs for advertising. How many dollars you pay per 1,000 impressions of advertising. But I think they'll figure that out and make that transition. I think it'll there'll be some bumps, but I think they'll do it.
Yeah. For those of you who didn't hear,
I really love this company called Amazon.com. Buy early, buy often, Steve.
I'm sorry I didn't get in at $1.25.
The product's not the stock.
If I had gotten
Get that salad spinner.
If I had gotten in at $1.25, you would never hear me say, but it was 113, I would say, I'm very happy with my 8-fold increase. I was going to say, for those of you who didn't hear the news today about Yahoo, they announced that they lost money in the first quarter and that they laid off, I can't remember what the number was, 1,200, 1,300 people. And that's what Jeff is referring to. Tim Kugel was our guest here just about a year ago. So he's having a tough time. So he'll take all the heat now, and you'll ride.
Well, I am ready for anybody else to take over the piñata job. That's just fine with me. I'm as much as I like Tim Kugel, he can have it.
Well, you've had a pretty good run.
Yeah, hey.
Let me ask you about your investments. Now, Amazon has made numerous investments in a lot of other companies. I made a list. Pets.com, Webvan, Ashford, NextCard, Audible, Living.com.
Yeah, thanks a lot for making that list. Did you mention Living?
No, but I'll put it on my list.
Might as well add Living.com.
Okay. Yeah, I did mention Living.
Oh, good.
So what does this do for the customer? The customer in your sense, not in the investor sense.
Well, so we made a number of these investments. The two most famous ones are probably Living and Pets.com, neither of which is around anymore.
Yes.
And we invested a significant amount of money and lost a significant amount of money. At the time we made those investments, we were very, I in particular, and a lot of people in the company were, I think, for the most part, rightly convinced of what had for a long time been a very useful metaphor for making decisions about the internet, which was the land rush metaphor. And we knew that some of these categories, pet supplies in the case of pets.com, furniture in the case of living.com, that they were not going to be on our priority list anytime soon. So rather than try to do these categories ourselves when we thought we had better prospects to do ourselves, we thought we'll kind of cover that ship by investing in these companies. Since this is a land rush mode, we don't want to miss out on this, and perhaps later we can integrate it into the company or do something else. So that was the rationale. Well, it just didn't work out that way. What happened with these companies is they built cost structures which needed much higher revenue bases to make sense. And when the revenues didn't show up fast enough for those cost structures to make sense, because remember, you refer back to our earlier conversation that e-commerce is a scale business. It's very difficult to be a small e-commerce company. Actually, you can be very small. It's very difficult to be a medium-sized e-commerce company. There's a very tough, sort of regime in the middle there. And so with a long enough financing runway, perhaps these companies could have achieved, acquired enough customers to achieve the scale that they needed to build sustaining, lasting companies. But when the financing runway or rug was pulled out from under them, they had to close their doors. There was no other alternative. I mean, the only alternative for us would have been to, put more money into these companies to try and keep them afloat. That would have been an even bigger mistake.
So they ran up their costs too high, too fast before they ran up their revenue.
Correct. Which, in a land rush model of thinking about the world is probably the right strategy. The land rush metaphor, in my opinion, was a very useful one for many years. But sometime in the last couple of years sort of faded away out of usefulness.
Mm-hmm. Do you think pets.com, the idea of having an online pet store, is a good one?
I do, for lots of different products. I don't know how big that category will ultimately be. For lots of different products, it's a very good idea. Probably not, at least operationally, the way they were doing it for pet food, which doesn't make a lot of sense to ship around by UPS. But for other kinds of, one of the things that's very important in online commerce is the average selling price of the item. And you prefer high ASP items, and especially high ASP, low cube items, so things that aren't that big. And dog food isn't great. It's sort of it's sort of intentionally cheap per pound, right? I mean, we're not normally serving expensive per pound foods to our dogs. So that piece of their business certainly didn't make sense. Then there are all these pet supply products which actually probably do make sense. I mean, everything from leashes and collars to stuff that's really obscure. And you have to remember, the more obscure the item in some sense, the better, because the higher the margins can be on that hard-to-find item. So, they sold a lot of ferret hammocks. I didn't even know that ferrets sleep in hammocks. So that's probably a good business. But the problem is, it's not a very big business, and so that's why probably that makes more sense as a category in a multi-category store like Amazon.com than it does as a standalone business. So the other thing that we learned, and we sort of knew this, but we just didn't know the degree to which this would be true, is that it was going to be very difficult to be what we call a monoline, a single category. And the reason is the same, that the fixed costs are so high. The e-commerce systems that we develop are very appropriate for, for not just books, but also for, DVD players. We can use those same systems.
Sure.
So it's not at all impossible to build these systems and to do so at a reasonable cost But in a land rush mode, people weren't even doing that at a reasonable cost. They were doing it at an unreasonable cost.
What about the grocery delivery business?
Now that's a tough business. So we invested in a company called Home Grocer, which was subsequently acquired by Webvan. And I don't know, we now own, I don't know the exact figure, but it's roughly 8% of Webvan, something like that. And, you know, that's a very tough, very capital-intensive business. So, customers like the service.
Yeah, it's just hard to make a buck.
It's really, really hard to make a buck. You need very high density of delivery density. It's like you need everybody in a neighborhood.
So it should work in Manhattan.
I mean, Manhattan in some ways would be a good neighborhood. Manhattan has other problems. I lived here for 8 years, so I know about some of those. My first year in New York City was very tough. You know, everybody's first year in New York City, none of the things, if you grew up in the suburbs as I did, nothing works right in New York. You know, the first thing I did when I got here right out of college was go buy a television set, and then I found myself standing on a street corner holding a television set, and no cab would stop for me. And I realized that in New York, you get everything delivered. But, you know, it takes like a year to learn these tricks of New York. So New York is a unique place, and a lot of things work differently here. And I don't know how well Webvan would work here.
I want to ask you two more quick questions.
Doorman would need big refrigerators.
Yes. That's right.
Store the milk.
Or doorman with a key to your apartment to bring it all in when you're not there.
And escort the Webvan guy into your apartment.
I want to ask you about privacy. Do you sell any of the information that people give you?
No.
Would you, if you sold some assets, or
if we sold a business, if that customer information was part of the business, of course.
So that was what?
Of course, it would go with the business.
And then the new buyer could then use that information in a way that
they'd have to use it subject to our privacy policy, because that's the that's the policy under which the information was collected. But of course, the information would go with it.
But the policy would go with it too?
Of course. You can't collect information under one policy and then somehow avoid that policy by transferring the information.
Okay, but the issue now comes up when companies go into Chapter 11 and the courts, the bankruptcy courts say the customer information is an asset of the company, and under bankruptcy the company can then sell that information in a way that the provider of the information, the original customer, didn't intend.
Well, that's why you should shop at a company like
Chapter 11.
That's why you should shop at a company like Amazon.com that's not going to go into Chapter 11.
Good. Okay. Maybe they'll have better questions than I have. All right. Is it as much fun as it used to be?
You know, the truth is, I don't think this is credible, but the truth is yes. You know, sure, you know, I liked being the poster child instead of the piñata a little bit more. That was good. But I'm a change junkie, and I love, you know, the rate of change, and I love the intellectual challenge of what we're doing. And I love the people I work with. We've got a great team, and it's fun. It's not like, you know, it's not like, you know, me against the world. We've got a big team of people, and we actually, you know, there was really only 1 year in our 6-year history where we were not the underdog. And really, we're much more comfortable in that underdog role. You know, we kind of liked it when we were Amazon.toast. And it's sort of nice to be back there.
Well, people will interpret that as that you're going to delay profitability in order to have a lot more fun. Does Amazon...
They will be wrong.
Yeah, right. Does Amazon have a B2B strategy?
Amazon has always had a lot of businesses as customers, but we don't have a specific B2B strategy. You know, what we try to do is look at segments of our customers, whatever they might be, So some of our customers are businesses, some of them are librarians. A lot of them, most of them, of course, are individuals. Some of those individuals are casual buyers who buy infrequently. Some of those individuals are very heavy buyers. So we just think of these different segments as different, some of the segments are more important than others in terms of how much business they do and so on. So we focus on them as segments. And for us, B2B is just a segment. B2B customers for us tend to buy, 100 copies of Who Moved My Cheese at the same time or something like that, or even 1,000. And we handle those orders in a different way and so on. And there are things for each of these segments that we can do more on later. By the way, one thing to do that B2B reminds me of, if anybody is an entrepreneur out there, it was a very clear lesson. Don't chase the buzzwords. It's so humorous to watch companies try to catch a wave. And really what you want to do is figure out what it is you do. And if you're a company that primarily serves consumers, and that's where your competencies lie, and that's what you've been focused on, don't change your business plan because that temporarily went out of vogue. There were all these things. Everybody was like a C2C, then a B2B, then a P2P, and then, it was
Yes.
ridiculous.
Given the market's concern about your liquidity situation, although you've
Reference
you've addressed
Moody's. Next question.
Well,
No,
we'll give it
okay, go ahead.
a fair chance. Why don't you issue additional equity or convertible bonds in order to remove those concerns from the market?
Well, we don't need to raise money, and one of the things that we have said is that while we say we don't need to raise money and we don't, we are reserving the flexibility to do so for strategic reasons or to strengthen the balance sheet, which is basically what this individual is suggesting. So we're not ruling that out, but we're also quite happy with our cash position, and maybe if the Moody's change helps things and so on, maybe the climate will change a little bit, and then and maybe that won't be necessary.
Pressure will come off. Yeah. Based on what you think Amazon.com has to do to turn an operating profit, this gets to the questions of operating efficiency that you were talking about. Do you think you're the best CEO to do that job, that operating efficiency job?
I think I am,
your background,
with a lot of help.
Yeah.
So, we have a very deep management team, the people who report to me and the people who report to them. If I had to do this alone, I would not be the right person. I have now about 2 years of experience in a multi-billion-dollar company. We have people on our management team, of course, who have 10+ years of experience as senior executives in multi-billion-dollar companies, and I rely heavily on those folks to help guide us and help try to step past some of the potholes. Inevitably, unfortunately, you must step in many of them, but you can avoid many of them as well by having a good team. And I think we really do have a good team.
Has the success of...
By the way, I should just answer.
Sure.
The reason, by the way, I think I'm a good person to be the CEO is because I know so much about the company and its history, and so much about our focus on customers. That part of it is also really, really important. And so I think we can get the best of both worlds. And when it comes to, operating a company of our scale, I'm paying attention and trying to learn, and very happy with the help and support that I'm getting from our folks.
I'm not sure I understand this. Has the success of eBay's Half.com negatively impacted Amazon's book, music, and movie business?
No, not so far as we can tell. And we're one of the things we've been very successful at is selling used. I don't know if you guys have noticed, but on many of our detail pages at this point, when you go to look at a book or music or a video, you'll see that there are also used copies available, usually for significantly less. And that's a model that's just, it has grown very dramatically for us and something we're very pleased with.
Well, this one we answered before. How did you pick the name Amazon?
Earth's biggest river, Earth's biggest selection. It had nothing to do with single-breasted female warriors.
I never would have thought of that. I would just thought of the river. This is related to, this is the privacy question, really. Amazon came under fire for altering its privacy guarantee to allow its huge database of customer information to be made available to third-party marketers.
No.
Is that true?
No, it's not true.
Okay. Somebody disagrees. We'll get them afterwards. If the rumors about a possible strategic alliance are untrue, should they be true? It's a journalist question.
Right. That's like a trick question.
Yeah.
I mean, well, today, of course, we did announce a major strategic partnership with Borders. This is our second one after Toys R Us. I think this is a really significant opportunity over time for the company. You know, we have built this platform that really is a unique asset, and we're able to service customers online better than anybody else just because we've been doing it longer, and we've been really focused on it. And we're finding that there are a number of, you know, leading branded retailers who want to focus on their in-store experience, which is critical to them. And those companies, I think there are a number of them who, over time, may decide to partner with us and let us handle the online piece of their business.
Well, the second part of this question is about the rumors about Walmart.com, rescuing Walmart.com from itself, letting them do the fulfillment while you handle the web traffic infrastructure. This was the rumors of Walmart.
Right. Yeah, and of course, and any specific prospective partnership, I wouldn't say either way.
That's too bad. Does Amazon.com have the optimal capital structure?
The optimal capital structure. I've seen very few optimal things in my life, so the answer to that's probably no. But we're very happy with it. I mean, if you look at the debt, which I think is, if I were to answer the question that I think is really meant to be asked, you know, we have a significant amount of debt in the form of convertible securities. But that debt, the principal on that debt doesn't come due until, of the big chunks of this convertible debt, until 2009. And the interest payments are relatively low. So, you know, we did $1.25 billion of converts in the U.S., and that has a coupon of about 4.75%. That's very inexpensive money. Then we did about 700 million of euro converts, and that has a coupon, I may get this slightly wrong, I think 6 7/8. Also very inexpensive money. And so our net interest expense per year, so we also make interest because we have a lot of cash. If you net the interest expense, it's, you know, $80 to $90 million a year, which to have borrowed $2 billion, or almost $2 billion, is actually very, very reasonable. I mean, that's a good financing. And people sometimes say, you know, do you wish that you'd done that financing with equity versus, you know, convertible debt? And you know, my answer to that is the high order bit. The important thing is that we did the financing, and then anything after that is, you know, sort of a question about optimization.
I read that Merrill and Goldman have no more stock to lend to short sellers. Hence the squeezes in the works. Are you secretly very happy?
Well, you know, I believe that you know, we are a very polarized, from the stock market point of view. From a customer point of view, we're not a very polarizing company. Pretty much everybody, even our harshest critics, will agree that we do a good job for customers. So we're sort of, unfortunately, dull in that way, which I consider to be really important. And then when it comes to the stock, it's an incredibly polarizing story. You know, we have people who are fantastic fans who've been with us all along, and then we have people who, you know, just think that this is, you know, the worst possible investment that anybody could make. And that's why you end up with these big short positions. I do think that, you know, the relatively small float makes our stock a very, you know, you should definitely be a very experienced trader to short our stock, even just for tactical reasons.
So the run-up in the last few days obviously
could easily have been, you know, accelerated by shorts having to cover.
Yeah. Good. What do you think of the financial media's coverage of Amazon and the internet?
Well, I would
Do
say...
I get to answer that question? No.
Yeah. There's been only one great magazine covering us. Yeah.
All right, next question. I know when to quit when I'm ahead.
That's right.
I'm $100 stock right now.
Well, so like all things, it's been mixed. I mean, I would say by and large, the coverage has been very good. And I'd say by and large, and certainly on balance, you know, we as a company would be the world's biggest whiners if we ever complained about our media coverage on balance, because on balance, the media has been very, very fair to us.
Write that down. Why are certain CDs, et cetera, available only on Amazon as opposed to a bookstore? Not sure what that question means.
I don't know, but I'm glad to hear that our selection is better.
Yeah.
We do have a lot of CDs that nobody has, in part because we have, and books and even DVDs and VHS tapes, because we have this thing called the Advantage program, where we let, you know, any publisher, no matter how tiny, send us 5 copies of their work. And so it's sort of, you know, we'll take 5 on trial. And we put them up on the website, and if they sell, we reorder more. So that program has been incredibly successful and actually generated, you know, some authors that have later gone on to get major publishing contracts.
How does Amazon determine the rank of books? A book may be ranked 109,000 and then be 79,000 next week, then be 189,000 the next month.
Yeah.
Why does that happen?
So the ranking system is, it depends on where it is, you know, in the rankings. So if it's one of the top 10,000 best-selling books, let's say, it works the same for the other categories too. So if it's in the top 10,000 best-selling books, then the ranking is updated once an hour based on a rolling window of 24 hours of sales. If it's between the 10,000th bestseller and the 100,000th bestseller, it's also updated frequently. I can't remember if it's once an hour or once a day. And it's based on a rolling 1 week's worth of sales. And then if it's beyond 100,000, it's based on cumulative lifetime to date sales.
So you get volatility from just the way that's ranked?
Well, if you're down at like 1 million, then literally
one book every 2 years.
Just so just a few copies sold could actually take you up 100,000 places.
So we can manipulate your list. Just have to go out and buy
At the low end of the list, it's pretty easy to manipulate. It won't do you much good. But I encourage it. Don't return it. It undoes the ranking.
What % of sales is books?
So if you look at books, music, and video as a group, we don't break out books without music and video. But if you look at US BMV, I'm doing this from memory, but I think in a year where we did 2.7 billion, I think US BMV was about 1.7 billion. Does that sound right to you? I think it's about right.
Presumably that percentage will go down as you...
Has been going down, and you know, the other big segments are international and early stage businesses.
Have you got any jobs in New York City?
What's that?
Have you got any jobs in New York City? It's from a laid-off.comer.
No, you got to move to Seattle.
Okay. Will I see an Amazon catalog in my mailbox soon?
A paper catalog? You know, we have no plans to do anything like that, but I also never say never on anything like that. If it made sense for customers, if it's something they wanted, we'd do it.
You made a big deal about doing things for customers, having a customer-centric focus. Do you honestly believe the customer is always right?
So it's very interesting. So our mission is what we call Earth's most customer-centric company. And we have a very precise definition for what it means to be customer-centric. And it is three things: listen, invent, and personalize. And listening is probably the most traditional meaning of customer-centric, and I think it's widely recognized that if you don't listen to your customers, you will fail. But I think that the second piece is most important, and it often involves not listening to your customers, and that is the invention. Because you have to remember that it's not the customer's job to invent for themselves. You know, every one of our customers has their own job, and they're inventing for their customers. And if you do focus groups and things, you will oftentimes be led astray when it comes to invention, because customers don't necessarily know in specific ways what it is that they would want. In fact, if you describe it to them, they may say, by the way, you know, I describe to many people, yeah, we're going to have a 1 million title book catalog, and you'll be able to order with your computer, and the books will come by UPS. And anybody, especially who was in the book business, thought this was a terrible idea. So listening only gets you so far. You know, there are lots of examples of this. The Sony Walkman, you know, they did, you know, a little bit of market research, and everybody thought it was stupid. This is inventing on behalf of customers is super important. Personalization is putting the customer at the center of their own universe, and designing the store, redecorating the store for each individual customer. Earth's Most also has a precise definition. What we mean there is that our mission is bigger than us. What we want to do with respect to customer centricity is set a new standard worldwide for customer centricity. And I actually use Sony as the example, very impressed by their early mission. Their mission was to make Japan known for quality. This is, if you know, coming out of World War II, if you look at this, it wasn't to make Sony known for quality. It was to make Japan known for quality. And actually did it. And if you have a mission that's bigger than your company, then, you know, it's more fun. And what we want to do is uplift the entire, you know, way that the world thinks about customer centricity. And if we will be successful if every company you know, if we set this new standard, which we have to do, and then if every company copies us and says we want to be that good at putting customers at the center of our universe.
You treat all customers the same. I mean, a lot of companies say we're going to lavish a lot of marketing attention, a lot of service on the customers that give us 80% of the business.
Or like Business Week, you charge your best customers more.
It works, Jeff.
I know.
No, but do you want to change chairs? Do you deal with your best customers?
You know this is true, right? All you have to do is let your subscription run out, and then they'll send you, like, you know, 80% off if you resubscribe. If you just slavishly resubscribe, you pay full price. Don't be fooled.
It still only costs, you know, $49 a year. But a lot of companies focus a lot of attention on their best customers and less attention on their less good customers. Do you?
Yeah, well, we would like to actually do more of that. At this point in time, pretty much we treat all of our customers the same. And we try to treat them all really well. But you're absolutely right. If you look at some of the segments, some of our segments of customers are, you know, relatively small percentage of customers, very large percentage of sales. And we would like to figure out over time ways to treat those customers better, because they're better customers.
Borders failed, at least in the online area. Why are you different? I think you touched on that. Borders failed.
Well, I wouldn't say that's true. I'd say they have different goals. And by the way, Borders is very focused on their in-store environment, where they really are a fantastic operator. They don't wake up every morning. The lifeblood of their company is not e-commerce.
Yeah. So, but they gave up on the online part of it. So in that sense.
Well, actually, I think if you, having just done about 15 interviews with the CEO of Borders this morning, I know pretty much what he would say. And he would say that they have not. In fact, they are, redoubling their effort, and they're going to improve the customer experience by outsourcing that to Amazon.com. And sometimes when something isn't your core business, and e-commerce isn't their core business, it does make more sense to outsource it to somebody who really is focused on it like a laser.
Mm-hmm. Do you still have a desk made out of a door?
Yes, I do. I built the first 3 desks and auctioned one of them off, and on Amazon auctions, my mom was the winning bidder. And she actually, it was a heated competition among several of the early investors in Amazon.com. So,
have you thought about offering...
By the way, door desks, these are solid core door desks, extremely sturdy, and they were great in the earthquake. Everybody's straight under those desks.
It's like a bomb shelter.
Oh, yeah.
Have you ever thought about offering financial services, for example, an Amazon bank?
Well, if we were to do something like that, over time, it would certainly be in partnership. That would be the exact kind of area where we would want to hook up with somebody who really knows that very specialized business and find some... The reason you would do that is because you would have enough customers that you would be a sort of buying cooperative for that big group of customers, and you would somehow cut a special deal for those customers with that bank and then offer it on Amazon.com. So that would be the sort of customer experience rationale for doing a project like that. And we would have to, it's something that I think perhaps makes sense, but over time.
Okay, I'm just going to ask 2 more questions. I rarely see advertising on your website. Have you ever run ads, and would you?
We only run ads, and they're not exactly ads, but only for our partners. So, for example, you'll see drugstore.com featured, on our website quite prominently. And then, of course, we use most of the real reason we don't run ads is because we basically advertise our own products. So instead of, putting up an ad to take you to some other website to, see an ad for Coca-Cola or something, we're advertising that digital camera that you can buy with 1 click.
Okay, this is a fitting question to end this. Is it true you've never ridden the elevator at your headquarters?
Almost true. So I've never ridden the elevator at our headquarters since we moved into the building. And but I did when we were looking at the building before we leased it. I rode the elevators. I rue that day.
Why?
No, I'm just kidding. I don't rue that day.
No, why don't you ride?
Well, it's an exercise plan, and what I've found is a very good motivational technique for me and exercise, which the 2 of us don't get along that well. And a good motivational tech for me is the winning streak. So if I can say to myself, I've never ridden that elevator since we actually moved into the building, then it's like, now that it's been 2 years where, and this is a 12-story building. So, and I have meetings on all the floors. This is a lot of stairs. I lived in a 4th floor walk-up on the east side at one point. That was nothing. And so it's actually a reasonably good amount of exercise sort of integrated into my day. And now, even if I have the flu or something, I come in, I look longingly at that elevator, and then I think about the fact that I'd be breaking my winning streak, and I drag myself up the stairs.
Well, great. So you have your Stairmaster at work, and you use it all the time.
Absolutely.
Jeff, thank you very, very much.
Thank you, Steve. Thank you.
American Perspectives will continue in a moment.